Okay. We could, let's get back on track. The next item is the Finance Committee. Chairman Covington.
Thank you. We have 2 information items and 4 action items today, all of which will be at least initially introduced by Vice President Burnett.
Thank you, Madam Chair.
Brian, you want to start with the fiscal year 2015 financial status report?
Thank you. Yes, I'd like to walk you through our financial status report and where the university on an unaudited basis will be finishing last fiscal year. They'll be available in the next couple of weeks. Our audit is nearing the finish line, but we'll cover the major items today. KPMG, your external auditor, will provide you required communications at the December board meeting on the UMSL campus. And so you'll see the final statements and their required reporting. So let's just walk through the 2 major components, an income statement and a balance sheet. The balance sheet for the University of Missouri system remains very strong. The asset side of our balance sheet is primarily our physical plant, our investments, our accounts receivable. Our liability side mainly is our debt, the outstanding commitments we've made, and the net pension liability over the last year grew by $200 million due to flat investment performance. And you're going to hear about the investment performance from Treasurer and CIO Tom Richards after this presentation. So we'll walk that through. But obviously the investment performance in the last year has a material effect on the financial statements, and you'll see that here today. Our financial position, despite being a tough investment year and very volatile, remains strong. This is the last 5 years, including the year we're discussing, 2015, and you can see we've grown and been relatively stable over the last 5 years. The net pension liability is what largely slowed the growth in our net position when we put that on the balance sheet last year at this meeting. But our balances remain stable year over year. Let's see. So our key ratios remain strong. The early implementation of the pension, GASB pension piece makes us look a little bit different than our peers, at least for a year. They're all putting on their books this year what we all did last year. Unrestricted net assets continue to grow even though we had lower investment returns. The other piece that will be great is that with the state reinvesting in our capital, that'll help on the deferred maintenance side and also improve the net position of the university. So there's some good, as that starts making its way into the books, the state's investment in our plant will help. And as you know, and Vice President Rodriguez talked about earlier, this fiscal year, the Government Accounting Standards Board announced the adoption of post-employment benefit accounting standards similar to the net pension liability. Those are coming in 2017. So it's something that we've got to work towards, and those will show up and affect our balance sheet. On our investment side, our investments returns moderated. Last year was really a very, very, very good year. It was very moderate this year, so that led to some slower growth over the prior year. Also, some changes here reflect the investment movements that the board approved around our investment strategy and our asset allocation. So those are what are affecting here. But at the end of the day, you can see that in 2015 we have roughly 3.4 there in cash and investments that we're holding. So just moderate investment growth, obviously, over the last year. We also, and we talked about this at the July board meeting, we continue to leverage low-cost financing for future growth. As you know, we're AA1 rated, and you can see our debt now stands at about $1.7 billion. We issued new debt last year, and new debt issuances also allowed for us to refund some commercial paper that we had outstanding. So managing that liability is important. But I'd also say that net position is also a measure of financial condition. We had a decline last year because we put the net pension liability on the books, but you can see now we've rebounded. Even though investment returns haven't been that strong this year, the trend is up, and that's good. It's good financial sound work. We would expect the same thing, that red arrow down, for many of our peers as they put the net pension liability on their balance sheet and have to adopt the GASB standard this year. So how does our unrestricted net position? It continues to grow as a component of net position. You can see at the bottom, the orange across the bottom is our unrestricted net position. It's now rebounding because we've put the net pension liability, we've accounted for it. And you can just see that we have different levels of net position, restricted funds, net investment, and capital is our largest. That's the blue bar across at about $1.6 billion. So our operating results did improve, and this is also known as our income statement. So in government accounting, there isn't an income statement. There's a statement of revenues, expenditures, and changes in net position. So this would be, so I've just finished the balance sheet. Are there any questions about the balance sheet for the university? So for our preliminary numbers on the income statement, operating revenue growth was driven largely by tuition and growth in patient medical revenue and MU Health. Our operating expense growth was driven by salaries and also the expenses that the MU campus had with the voluntary separation plan. That drove some expenses higher. But overall, our growth and operating revenue were largely equal, and this indicates that the university is managing its costs while continuing to grow. Net non-operating revenues are largely a result of the investment returns. That big change, that big swing from last year is largely investment returns. Last year were very good. This year, not so much. The other piece that's in there is the healthcare system took a $10 million non-recurring charge for the closure of the MRC in Mount Vernon. So that was a non-operating reduction as well that won't flow through next year. But if you look at the top line there, operating income across this entire system last year went from 60 million to 70 million, and that's our current numbers as we wrap up our financial statements. The other piece to remind the board and others is we have a well-diversified revenue stream for this system. And you can see at the bottom, our single largest stream is our healthcare system. 32% of the revenue for the MU system comes from our MU health system. State appropriations at 15%, tuition from our students and their parents at 22%. You can see our auxiliary operations continue to grow. The businesses that we run, our dormitories, our bookstores, those types of things, grants and contracts about 9%. So this is where we bring in the money that fuels the University of Missouri system. In December, you'll hear more detail about MU Healthcare, but we thought we'd at least show you that year over year, MU Healthcare continues to have strong operating results. You can see their operating income, actually before the non-operating revenue charges, went from 39 million to 65 million last year, an increase of about 67%. Their non-operating revenue, that 43 million, is 10 million for the MRC closure at Mount Vernon, and the investment returns not being, because they have investments inside our investments as well. So, but if you can just, you can see, despite that, they had an increase in their net position of year over year. But I think the net operating income is the number that we should be most focused on, because that is where management can have impact on its ability to generate returns from MU Health. So the ratios that we would look at are interesting, and they'll change when we put the net pension liability on the balance sheet last year. But you can see this is our trend. This is the University of Missouri system trend. You can see the primary reserve ratio, the viability ratio, and the return on net position actually got better because we reduced, we actually put in the net pension liability, so that has a little bit of a piece there. We lay that up against where Moody's AA1, and while we may be trending a little bit away, again, only the University of California early adopted the net pension liability last year. None of our other peers did so. So we expect those numbers to flatten out when we look at this a year from now and look closer to our peers. And just a reminder, you've seen this list before, it's kind of busy up there, but on the left are the AA1 rated public institutions of higher learning in the U.S. On the right are the AA2, but it shows there are plenty of healthy institutions, financially healthy institutions to the right on the AA2 list, for most assuredly. But we continue to be up in the AA1 for our debt. We are well positioned for growth. The composite financial index really is those four ratios and blended together into a single measure. We should strive for a score greater than 3 to be well positioned, and we slipped largely again. You're seeing the net pension liability weave its way into these ratios. And again, not to be a broken record, but you're going to see our peer institutions come down probably closer to us when they put that net pension liability on their books this year. Overall, we are in a good position to direct resources towards our institutional initiatives to reach our future goals. So the summary, candidly, is our balance sheet remains strong on our unrestricted net position. Our positive operating margins will continue to grow our net position and our balance sheet position. We continue to manage our lower cost debt to finance growth of our institution. But in that first bullet there, growing liabilities, specifically healthcare for retirees, threaten the university's strong balance sheet position if we don't do anything, as Vice President Rodriguez talked about. So I would say it's been a very, very good year for the university financially. Are we completely out of the woods in the future? No, but at least we're recognizing it. We're working on a plan to address it, just as we did with the net pension liability. And I'm happy to take any questions from members of the board.
Questions for Brian on the financial status?
You briefly explain the ratios, what the ratios are?
Sure. So the primary reserve ratio, let me get back to my slide here, is just how much money you have available to cover your, it's a percentage. Hang on just a second here.
121.
Yep. So the primary reserve ratio, Chairman Cups, is just about how much money we have available to cover our existing liabilities, those types of things. It's something that stayed pretty steady, but dropped because we put the net pension liability in, which reduced our unrestricted net assets. So I didn't bring my notes on that piece, but it's about the unrestricted net assets and how much of your debt you can cover with your unrestricted position.
Current assets against debt or expenses?
That type.
Against
Debt,
debt?
yeah.
Okay.
So, and then return on net position, if I can just jump down to that one, our net position, how did we return on that? Well, our net position dropped because we took the net pension liability, so the denominator dropped, so our operating return actually pumped that number up from 5.2 to 8.7. The net operating revenue is essentially everything that we do that's not investment or, long-term things. It's our net, how did we do year over year? And we stayed pretty steady at 5.1 versus 5.6 last year. So that the net operating revenue is all the things that are current year expenses over current year revenues that came in. Up to the viability ratio, part of the reason we dropped there and Moody's is above us is, again, that is, I'd have to remember exactly what the denominator is, but that is our unrestricted net assets against, I think, our entire, I'd have to get that piece for you, but you can see that we're at 0.93, we were at 0.91. Again, we think that the Moody's chart there on the second to right column will all come down as they put those net pension liabilities and join us with the rest of the group catching up. So, but I can get that viability ratio and how that's calculated. I didn't have it in my notes, I'm sorry.
In the 2014 figures, it doesn't include any liability for the retiree medical benefit, is that correct?
We don't have the full liability on the books. We have the cash costs are coming out. But that's what, in 17, we're going to have to book that liability.
Okay.
And we are not booking it today, but we will have to book it in 17. So we need to prepare for that because that'll do just exactly what the net pension liability did to our balance sheet this year. Hopefully to a much smaller degree than what we had to take last year. If you recall, for those who were on the board last year, it was about a $500 million write-down of our net position to put that net pension liability on the books. So a lot of it depends on investment performance, and now you're going to see how that also affects your pension liability, because obviously if returns are higher, it helps you fund your pension. If returns are flat or challenged, it makes the pension liability higher.
Thank you.
Does that help?
Would you go back to the pie chart?
Sure.
I have a couple of assumptions and then probably a question, but the healthcare being 32%, when we look at the revenue sources, trust that the bond rating is based on the system inclusive of healthcare. Is that Is that right?
When they rate the University of Missouri system, they do take into account the healthcare piece.
Right. And the healthcare piece is doing well,
It is here, yes.
throwing off margin again
Right.
this year. And the next assumption is that that stays within the healthcare and medical school, or at least the health sciences. So you don't take part of the, let's say, the margin and throw it to arts and science. Correct?
No, it stays mainly in the healthcare arena. There are some payments back that, you're right, there's some net revenues that flow to the School of Medicine, a little bit to the School of Nursing and School of Health Professions. But yes, it stays within that healthcare realm.
It does seem that we ought to be, the health of the health care and the fact that it continues to throw off margin but generally use it as an entity could be masking inefficiencies in our academic institution. In other words, particularly since it's a third of our sources of income. So I guess I hope that you have one screen that shows what healthcare is doing, not a pie chart, but I hope that we think about this and
Right there.
we spend more time thinking about the university than we do about the health system, maybe appropriately so. But I think that we ought to continue to be looking at them separately because they are separate in terms of income and frankly efficiencies. And you know, they're totally separate in terms of actually what the risk is, as well as what their function is. And it's great that we can combine them for our bond rating. But I think that we as managers and fiduciaries need to keep in mind the separateness and not be lulled into complacency because the health system is currently, let's say, masking efficiencies or savings that we probably ought to be looking at from an academic standpoint. That's my question, and I think my assumptions were correct in getting to that.
Well, let me just say a couple of things. An academic medical center has a certain status from the federal government, and it does result, because of its teaching mission, in higher reimbursements from the federal government than other medical centers. So in respect, they do get a bump from being part of MU. So there is some piece that they're being compensated for the work they have to do to help in the research and teaching, most notably the teaching mission. But I agree with you, it's something to watch very carefully. It is blended as part of our system. Their debt is part of our system. They're not separately identifiable. And my staff and I get their monthly operating results by the 10th or 15th day of the following month. So we are literally looking at their operating results every month. We send them to the president, we send them to the board quarterly, obviously to the healthcare advisory board. But I think your point's well taken, just watching this carefully, because there are some institutions, academic institutions, that have health systems that are not performing like MU Health is performing at present. And they're making different decisions about alignment and part of the system. But I think when you look at what this current leadership has been doing, but this is another 8th year of positive net margin, 8th year in a row. There's some really good things happening there from a patient satisfaction perspective. There's a good thing happening from market share, but it is absolutely something we have to keep our eye on as fiduciaries of the whole system. I don't disagree with anything you've said.
So let me just comment on what Curator Phillips said. If you take a look at the chart in front of you and you see the net operating income of the hospital at $65 million, and if you saw the previous chart of the roll-up of all of the University of Missouri system, inclusive of the hospital, it was $70 million. So there's $5 million of net operating income that comes from the other $2.1 billion of revenue, which includes the academic enterprise, the auxiliaries, et cetera, et cetera. But you can't compare hospital financial performance to academic performance. Hospital, and that's why you'll see in the December meeting presentation by Mitch Wasden that when you look at hospital performance, you compare Moody's similar hospital performance, and there's different metrics in terms of operating margin, best practices, or in the top quartile. And so you'll see some of those comparisons. Your point's well taken in that we should never feel good that, well, we've improved net operating income, and the majority of it comes from the hospital. We have to look at the academic enterprise and auxiliaries as well. You're dead on, and that's what we're doing as part of the budget conversations with each of the 4 campuses, including the hospital, to make sure that they're spending appropriately and not spending beyond their means.
Do the operating expenses shown there, does that include the transfer payments to the medical school and the nursing school?
I believe that there is, it's in both places. There's some that comes out of operating income, but there's some that are up there in the operating expenses, and we'll have them detail that for you. But yeah, there's some transfers both above the line and below the line that they're making, because there's certain thresholds in agreements that the schools and the campus have with the system. If they increase to a certain threshold, the payments move to a different level. And we're going to have Mitch detail that for you for what happened last year. The other thing, when I talked to him last week about getting ready for the December meeting, was not only talking about how they finished this year and what this year, how they did this, but also they'll have 5 months worth of this year's data that they could bring you up to speed on at the December meeting. So it'll be both a look back at last year and a kind of a year-to-date update where they're at 5 months into the fiscal year. Any other questions on our financials?
As I understand what the president just said, that there will be in December a peer-to-peer comparison on the health system finances. Is that right?
There's just different ways to look at it. We can certainly put that in, make sure that's part of the presentation.
Yeah, specifically the hospital, there's Moody's
Yeah.
ratios that will compare the hospital's performance against Moody's best practice ratios. So we'll be looking at those statistics.
And then my question was, because that was my understanding, my question is, do we have an opportunity to have that sort of peer-to-peer comparison with the academic enterprise?
Well, you do, as a system, because we're organized as a system, you can see that.
That
how
was on that
Moody's-
previous,
That was that slide. Can you
previous
bring those slides
ratios.
back up, please? The best gauge you have is this list, because this they're not separately
Well,
looked at by Moody's.
that's
other
what I was
than
asking,
our debt.
is whether the income aspect of it is there's any sort of peer-to-peer comparison.
Well, when you say peer, not all of those schools have healthcare systems.
No, that's why I was wondering if it's ever broken out for our academic enterprise to be compared to the academic enterprise of other
Well,
schools.
I think candidly, the healthcare piece is seen as an integral piece of the academic enterprise for MU's mission. If we didn't have the healthcare and the teaching hospital, the medical school, the nursing school.
And
I don't
I'll
know
drop
that
it
there's
now,
a
but
way to
that's not
break
what
it out.
that's not what I'm saying. I'm
Okay.
just saying, is there a way? I personally, we'll talk about this later at some time. I think where on the information that I personally receive is a little light is on peer-to-peer comparisons, and that's why I was wondering if there's any way to obtain that just on the pure academic enterprise so that we can compare
Are you talking about monies spent?
money spent and revenue, the whole gamut.
Well, in the development session,
That's
we
already-
did peer-to-peer.
Right.
And that was by no means light, so if you need more reading or more information, challenge us. But what we tried to do was take a look at the peers for the 4 campuses as well as the system peers relative to performance overall.
Well, no, and I understood that. I was wondering if there is a rating system like I understood you to say that they will have for the health enterprise, whether any of that is available for different aspects of the academic enterprise, but it
Not
doesn't sound
beyond-
like it.
To
Yeah.
my knowledge, not beyond what you're seeing right
Yeah,
there.
okay.
Any other questions?
If there are no other questions, let's move on to the investment performance review.
So Tom Richards is here, along with Barry Dennis with SIS, and they're going to walk through the investment performance for the last fiscal year. And Tom and Barry will be glad to take your questions as they walk through that. Thank you.
I wanted to start off briefly just with some perspective. All of you had received the quarterly results, or I'm sorry, the quarterly board update, which had the actual results as of June 30th. So we'll go over those, but you've had an opportunity to look at that. I wanted to highlight a couple of things, and I thought it would be appropriate to start out just with some quick perspective on markets, because everyone's been concerned, appropriately so, about market turmoil. This was an interesting presentation I saw from one of the research services that we subscribe to. This is plotting out every sustained bull market in the history of the S&P since 1927. So covering a span of 88 years. There have been 25 sustainable bull markets during those 88 years. The one that just ended in August was the third longest in the history of the S&P. So again, we kind of forget sometimes the context coming out of the financial crisis. The point is, we've been on an incredible run coming out of 2008, 2009, and at some point it was going to end and the market was going to make some moves to correct. But in terms of it being the third longest bull market in 80 years, that surprised me. Another way to offer some perspective, we may have shared this in a quarterly board update. This is just a pictorial representation of monthly returns on the S&P 500. Just happens to go back to January 1992. If a cell is highlighted in yellow, that was a month when the loss of the S&P was between 5 and 10%. If the cell is in red, the loss was greater than 10%. So it just gives, again, some perspective on the volatility that's pretty normal from time to time in the markets. And it also points out from roughly May of 2012, where we had that loss of 6.3%, we went through a very long period of time with no significant corrections within the market until we got to August, and the S&P 500 was down 6%. And just for information, the S&P was down an additional 2.6% in the month of September. But again, in perspective of the bull market and the run, I think that the correction that we're going through is not to be unexpected. In terms of a quick summary of activity, this is a roll forward just from the beginning of the year to the end of the year. We've seen this before. It outlines, for example, in the retirement plan, the contributions of the university, the employer contributions going in, the benefit payments going out, the investment income. The thing that I wanted to highlight, just because it's unusual this year, in the endowment, you'll see a transfer of $69 million. And that relates to a separate endowment pool that we had run called the fixed income pool. That was a compilation of mainly older endowments that had specified certain things, such primarily fixed income only investments. And so they had been in a separate pool. There was a change in the Missouri statutes, which actually I think we had a role in helping get that, the general counsel's office, that allowed us more flexibility, and it basically allowed us to move most of those endowments out of the fixed income pool and into the endowment pool. So that was kind of the one-time transfer. There's a small number that even with the change in statute, we still could not move. So I think there may be something like 2 or 3 million that remains in the fixed pool. But in terms of the donors and the beneficiaries, that money will be much better off in the endowment pool overall than in the fixed income pool, because as you know, fixed income is not generating returns right now. In fact, it's quite the opposite. I want to quickly introduce Barry Dennis from SIS. He's going to give a quick overview of the firm. SIS is the investment consultant that's hired and approved by the board each year, and then we'll get on with the overview.
Thank you and good afternoon. So we've been in business since '94. You hired us in 2011. I think for those of you in marketing, the hook was at the close. I informed the committee that my daughter had selected University of Missouri. It's hard to believe that she's now a senior. Time flies. So the three pertinent things of our business model that differ us from the competition is that, number one, we have no conflicts of interest. Number two, we work with large funds exclusively. Of those 28 clients, it totals about $450 billion in assets, so an average size of about 15 billion. And number three, it's a small group of investment professionals, but they're highly experienced. Even our analysts, our research analysts, average 20 years of experience, which is unheard of in the industry. So we feel a very experienced analyst can do the work of a small army of college graduates who are new to the industry. We specialize in a few things, most importantly, asset allocation. For you, when we were hired, and in 2012, we significantly recommended that you raise the equity allocation from high 30s to 50. So you rode that wave from 2012. The recent allocation that you approved in June has taken some of those winnings off the table and brought that back down, and we hope that works well. Of the other things we do, one that isn't mentioned is fee negotiations. Because of our client size, we have some clout in the industry in helping to negotiate fees, and we did a successful project for you last year. We appreciate your business, and thank you very much.
So getting into asset sector returns, or I'm sorry, these are the targets. This is just an illustration, as Barry mentioned, and you know at the June meeting you approved new asset allocation targets. This is taking a look at where we were at June 30th in the actual column versus the new targets that you approved. And we'll talk more about this, but this just illustrates the changes in the portfolio. And I'm pleased to say, and I'll provide more detail, we're almost at the new targets now, and we'll go into that. This is kind of an interesting look at asset class performance, which I thought this year is particularly important to take a look at. This goes back to fiscal year 2000. It shows several things. One, you can see that our portfolio has been getting more and more diversified. That's for sure, and that's a good thing. Particularly though, this last fiscal year, 15, you can see about half the asset classes are above the line and half are below. Wide disparity in returns, and a big component of that, which we're going to talk about for a few slides, is the impact on currency and returns, particularly the strengthening of the US dollar. So if you look at the yellow box, third from the top, you'll see US equities. The benchmark return was 7.4% during the fiscal year. But if you look down below, international equities were down 4.7%, emerging markets were down 4.8%. Almost entirely due to the strengthening of the US dollar, and we'll talk about that. The other thing to point out as you start to hear peer comparisons come through, particularly with the larger endowments, you'll hear returns that are really, they're not considerably more than ours, but they are higher than ours. And I'd point out the top two boxes in terms of private equity, where we had a 14.6% return in real estate, which returned a similar amount. The bigger endowments, as you know, are heavier in the alternative investments. And the alternative investments in this past fiscal year did particularly well. Interestingly, the prior few years before, we were outperforming them because we were heavier in public assets. So the main thing here is that the asset allocation matters a great deal in terms of the returns that we generate and the risk that we take. So here are the one-year returns by sector.
Would you want us to ask questions as you go through the slides?
Whatever works best.
If you go back to that one.
Sure.
So what I noticed visually about this is the increasing complexity of the allocation over a 15-year period. And it's really dramatic when you see it up in color. Simple question for you is, do you know over the 15-year period whether the management fees all told have increased in the last, say, 3 or 4 or 5 years where we have complexity of investments as opposed to the previous 5, 10, 15 years? Just as an absolute, I mean, it's hard to average them all because
Right.
Each segment has its own separate manager fee, but are we paying more for managing or less for managing than we used to?
we would be paying more, but the decisions to diversify into the other asset classes are driven by strategy and the benefits of diversification itself to the portfolio's return overall. To do that, you have to do that with the acceptance that in certain asset classes, the fees are going to be higher. You're always looking at that and evaluating that on a net of fee basis. So this is a good year as an example. Without some of the diversification of private equity and real estate, our returns would have been probably below zero. So, but the answer.
SIS, basically, with our guidance and approval of certain allocations, makes the allocation decisions, and their fees, in terms of, who to select, but their fees are relatively modest, I think, compared to the management fees of those actively management investments. Am I right about that? SIS has a different, they have a different fee structure that, dare I say, to a vendor is relatively modest compared to active management fees.
Oh, absolutely. It's a fixed fee to
Yeah.
SIS.
Could I intervene if I didn't misunderstand? I thought you said that SIS is sort of telling us what to do.
We give them the general guide, and then they make the decisions.
Well,
The board
could we
approves the
clarify
targets.
that? Yeah.
And the staff makes the decisions collectively with the assistance of SIS. SIS is not making decisions for us.
It's a partnership
Yes.
at best, but you have the final say.
Well, under the authority delegated
Yes.
by the board, we
Right.
have the vice president for finance, the treasurer. The consultant is there in terms of check and balance. We have a full legal review from the general counsel's office, and we have the ultimate consultation with the president.
Right.
So I'm just bringing the ghost of the past forward from Don Downey's view that the complexity and the management fees over time, and I'm sure that you're familiar with this question. We're paying more for the advice. We've approved the allocation. SIS does what we want. So it's not SIS's choice except the actual placement. So is it a substantial increase in fees to get this complexity of investment? I don't know.
I would not say it's a substantial increase in fees, because the other factor that's involved is if we go way back when the portfolio was relatively simple, it was entirely active management. And so from some standpoint, those fees most likely in those active management accounts would have been higher than what we're even paying today for active management. So there's a lot of variables.
That's true. Index funds 15 years ago.
At the end of the day, though, is we keep kind of going back to, we make decisions for strategic reasons, and when we're making those strategic decisions, they're always evaluated in the context of a net of fee basis. So fees do not enter into the, if an asset class has a high fee, and we look at it on a net of fee basis, and we're not satisfied with the fit in the portfolio, we're not going to put that into the portfolio.
Okay. I'm going to maybe come back to this after you're all through, but I thought this was a good departure point to get that question out on the table.
Okay.
So is your question really, what is the value add?
Yes, of
Okay.
higher fees than we might be paying with
So that's really cuts to a question to you. What is the value add?
Well, as Tom said, if we hadn't had the non-public securities in the portfolio, the performance probably would have been reduced by 3 or 4 percentage points in the last fiscal year.
There's your return on investment.
and the year before that.
We'll actually have some data that'll
It
that'll
does
get
vary
your
from
point.
year to year.
Absolutely. Okay. So let me run through the asset classes, and again, these are similar issues that we've talked about. Global equities, I will mention again, we've had underperformance with some managers, and I would say that the managers that have been underperforming have been terminated. We're going to talk about the new equity structure that we also discussed with the board in June and April, and I'll update you on that in a few slides, as well as the absolute return of equities overall. Private equity, we're very pleased that we outperformed the benchmark by 270 basis points, and the history of that is that we continue to grow that program to get to our targets, and we're getting to the point where the program has matured enough where the drag of startup costs is not holding us back as it had. Real estate also, we're pleased to be above benchmark. Real estate was our worst performing sector in the financial crisis. Had some significant losses in a particular investment that was entered into in 2007. We've been working hard to sort of rejuvenate that part of the portfolio, and we're pleased with where we are. Global fixed income, this would be just an example. The benchmark was down 7%. We were down 3.8%. That's active management. Our partners, PIMCO in particular, on that line item. Inflation-linked bonds, I would just highlight as the worst performing asset sector. The benchmark was down 12%. Our account was down 10.5%. Again, just putting into context about the change in perception about the growth outlook, overall inflationary pressures. So inflationary expectations have been going down as growth expectations have been going down, so TIPS underperform. It's a straight relationship. Risk parity, the return, the negative return of 2.8% is actually consistent with our expectations. Risk parity is particularly difficult to benchmark because of the nature of the strategy. So the variance to benchmark is not as meaningful at this point. That's something we continue to look at, and I think every other institutional investor with risk parity struggles with the same problem. So global equities, so again, I mentioned the two issues. One, we had really a need to change the structure, and we did, and I'll talk about that. The other big issue with the absolute return overall has to do with the fact that we run a global portfolio, which most plans do, but not all follow the global benchmark. This is just an illustration of several things going on, but the bottom line is this looks at the span of the fiscal year. The thick black or gray line at the bottom is the actual experience of our benchmark, the MSCI ACWI IMI, which basically is a representation of the entire global equity market. It's kind of like owning the market, and that's what we benchmark ourselves to. The blue line at the top is showing the appreciation of the US dollar throughout the year. The dollar strengthened almost 18% during that time. So the problem is when you're investing in securities overseas that are not denominated in the US dollar, their performance could be just as good as what you're getting in the US, but because the US dollar is strengthening and those returns come back to you in the US dollar, the returns are compressed. I think that may not be the most straightforward, but to think about, the green line is labeled global equities, local currencies. It has an 8.5% return. So that's the same benchmark, but what's that's saying is that if you just looked at the returns in each one of the countries and each one of the currencies where those returns were earned, and currency exchange was not an issue, the return of the market would have been 8.5%. So what it's really saying is that the difference between 8.5% and 1.1%, which is the US dollar denominated, is the impact of the strengthening of the US dollar. So for people with global portfolios representing basically the global cap weight of the equity space, this was a big issue this past year. So naturally the question becomes, do you hedge your currency exposure? And that's something we're going to be talking about. The problem is it goes both ways, and in most years, this is a comparison of returns. The US dollar return is the blue in blue, and the local currency return is in red. Again, this is the same index owning the same companies. In most years, it's kind of give and take. Some years it's up, some years it's down. What was just unusually challenging in fiscal year 2015 was the magnitude of the difference. So the other thing that this means is that a decision to hedge is not an automatic one because it's not something where you're going to win all the time. So that's something that we're going to be taking a look at. SIS is going to help us think through. We're going to discuss it with our advisory group in terms of what we should be doing with foreign currency risk management. So getting back to the, continuing on rather with the equity structure, this is just a reminder. The graph on the left-hand side was the portfolio, the equity portfolio before changes were made. And the new structure that you approved at the June meeting is on the right-hand side. You'll see a dramatic decrease in traditional active managers and more of a distribution or diversification of the approaches that we're using. A couple of things. One, I'm pleased to say that at September 30th, so 3 months after approval, we have repositioned almost the entire portfolio. We did it in 3 months. The last time we made a change, it took us 12 months. So we've been very efficient. The General Counsel's office has helped a great deal. We've had a tremendous amount of review on all fronts and SIS, but we worked together very well as a team, and we were able to execute this quickly. The other highlight I'll just pass on, this is just really brand new this month. As you may recall, in our discussions on portable alpha, that green slice of the pie, the passive cap weight, that's the portable alpha program. Again, that's the exposure that's implemented with the derivatives that we discussed. Through last Friday, we've had 300 basis points of outperformance in that program through 22 days in September, which has resulted in an excess return of a little more than $12 million. So we've had a very successful launch. That won't happen every month, but it is sort of the power of, without getting into too much detail, separating the beta from the alpha. So the beta exposure in this case is extraordinarily low-cost futures. And we're getting the alpha separately, and the alpha managers delivered quite well.
Is that what we talked about the last session, where you went into some detail about it?
Yes.
And recommended we get into that?
Yep. And we will, in the quarterly board update, we will have a section of that highlighting this program to make sure we keep full transparency on that so that you can see the returns.
As I recall, you indicated you thought there were going to be higher returns and lower risk by doing that.
Over the long term, yes. Yeah. September was an extraordinary month for some of the funds that we invested in. And again, a 300 basis point return you might hope for over the course of a year with an active manager that was really, really good or really lucky. And we were able to start out in the first 3 weeks with that. That won't repeat.
You don't want us to hold you to that.
No, please don't.
Okay.
Tom, would it be accurate to conclude, when you look at the chart on the right, that your management fees in total will, on a percentage basis, be reduced as compared to the previous model where you had 57% of your portfolio actively managed and now goes to something that looks kind of like 25%? Back to John's question.
The base fees will certainly be lower, and I'm
Okay.
going to talk about that. It's part of one of the things that we've been negotiating is better alignment with managers. So we have incentive structures, and I'll go over that when we get to the plan fees. But base case scenario, absolutely.
We actually hope the fees go way up. Because then we need a whole lot of.
Yeah. So overall, again, we've had this. The retirement plan was just about at benchmark. The endowment pool is a little bit under benchmark. That had a lot to do with sort of the math weighting and risk parity, which I can get into or talk through at another point. And the absolute returns overall in that 1% range, the biggest contributor there again is the strengthening of the US dollar. Performance attribution, we sent this out with the quarterly board update. We haven't talked through it entirely. I'm going to focus on the left-hand side of the page just very quickly. This just takes for you the overall variance from benchmark, and it breaks it out by asset class. And this takes into account the variance from the targets that have been established, as well as the absolute performance of each one of the asset classes. So the total portfolio at the bottom showing a negative 16 basis points, and you can see where that's coming from. So global equities certainly is 40 basis points of that, offset by good performance, particularly in global fixed income, and outperformance on tips. So even though tips were down, we outperformed the benchmark, so that's a positive contribution to return. The right-hand side is just looking at the economic balance of the portfolio, showing you by sort of economic positioning how that performed. The thing that's consistent with the tips, if you look at the red up at the top, that's an inflation rising scenario, and that group of assets was basically flat to a little bit down. Those are tips and commodities.
Can I ask one question? What was because you had a previous chart, was the global equities, was that mainly active or passive?
That's a mix. I mean, even in the prior structure, that was.
But I mean, what's the percentage? I thought you had it broke out. I may be wrong. No, that was different than.
Yeah, well, so the prior structure, the passive cap weight was 22% of the portfolio. The factor premia is passive-like, so we just increased that in the new structure.
So in your global equities, what's the mix, passive versus active?
Well, this is the global equity.
Oh, okay. I
Yeah,
see what you're saying.
so the inner circle is kind of showing you what kind of a manager it is. The outer circle is just showing you the global disbursement.
Okay.
But we've gone to a more passive-like structure, more systematic structure. So this is similar by the endowment pool. Again, the big issue, the endowment pool had a higher allocation to risk parity, and that's the 25 basis points down. Real estate is down 30 basis points, and again, it's sort of counterintuitive because our real estate portfolio outperformed the benchmark, but we were below target because we're still building that portfolio, so that's a drag on return. Longer term returns, 3-year, 5, 7, and 10. So Curator Phillips, just to get back to your question, this is something that we began to follow and track and report to the board. Our 10-year return, let's just say in the retirement plan, was 6.2%. Had we been invested over that 10-year period in a total passive portfolio, so 60% in the passive equity benchmark, 40% in a passive fixed income benchmark, that passive portfolio would have returned 5.8% over the 10-year period. So in terms of figuring out on a net basis the value add of the diversification and the active management, that's the difference. If you take that and apply it to the retirement fund and the endowment pool over a 10-year period, it's $160 million of value.
Can I follow? Because that's where I'm not following. Are you, when you say if you compare that to a passive, are you saying with the same asset allocation and the same risk, or are you talking about just a basic equity passive?
So the equity benchmark we use is the same equity benchmark that we use for the portfolio. It's
which is?
The MSCI Equity
Okay,
IMI. It's
okay.
the global index, and the bond index is global as well. We use that because we run a global portfolio.
Okay.
So the 60-40 passive is an approximate proxy for what we're running on an active basis. So it's kind of back to the question of, is there value? There's $160 million of value that we've been able to capture over 10 years.
But is that from asset allocation, or is that from passive versus active? That's what I'm missing.
Well, it would be a combination. I mean,
No, I see what you're saying. That's why I wanted to say, it's not all passive versus active. It's
diversification of
Yeah.
other asset classes.
yeah, because you can have passive and active within different risk pools too.
Turning to the,
But does everybody agree that the summary of that is there is value to having a mix of active and passive if you pick the right active and get value for that investment?
Well, actually, I am not criticizing this. There are some very smart people who would disagree with you on that. It's an interesting argument. My only point is that you have to compare apples to apples and oranges to oranges.
Correct.
You can't simply say global equity and then expand that out by different asset allocation and say you're comparing active to passive. It is a more complex mix than that. That was my only point. I still happen to be one of those people who believe nobody can beat the market over a 10-year period of time. But he is not just comparing active to passive. He's comparing a change in asset allocation in addition, which I wouldn't argue with.
No, I thought that you were using the same asset allocation of 60-40 and just comparing our performance over a 10-year period of time versus an indexed performance of a similar distribution over that period of time.
the
Am I incorrect?
60-40 mix is a pretty good proxy
Right.
for the equity debt components of
The
our
equity
portfolio.
debt, but that doesn't include the other asset allocations.
And part of that, just in terms of this exercise, several of the asset classes you can't own in passive form.
And that's what, I agree with that.
So you have to
I agree with
simplify.
that.
We'd like to talk about the general pool. We don't talk about it that often, but we do report to the board once a year on it. The general pool, again, is the summation or the aggregation of all the university's cash and investments on an operating basis, including the healthcare system. The pool returned, this is not terribly exciting, but it's not supposed to be. The pool returned 87 basis points for the year compared to the benchmark of 84. You can see the mix of investments. It is very conservative, and for a reason. This is the liquidity of the university, and we're very methodical in terms of how we plan and manage this. It plays into our debt portfolio management as well. So when you look at it, the first 60-70% of the portfolio is pretty conservative in terms of fixed income. Overall, the performance was very good, both internally and externally. Same issue with risk parity. I would argue it's more of a benchmark issue. When I looked at this from last year, with the same risk parity managers and the same strategy, we beat the benchmark by 7.5%. So again, it's more that the strategy is difficult to benchmark. But in terms of the actual expectations that we have for risk parity, it's meeting our expectations. The other investment pools, I mentioned the fixed income pool, so this is down to $2.3 million. Just return versus benchmark. The performance is just, it's an actively managed account. And then we have post-employment, the OPEB trust, which is topic of a timely topic. $67.9 million in the trust at the end of the year. We beat the benchmark. The negative returns were from fixed income. And partly that's the same story, where the fixed income is a global fixed income portfolio, and the currency impact was the same with that as well. So on to everyone's favorite topic, investment management fees. So I have quite a bit I'd like to go over on this. So first of all, the fees for each one of the plans is listed up above, 69 basis points, 73 and 28. Just start with the general pool. Again, it's a very conservative bond-oriented portfolio, and we run probably $600 to $700 million of it in-house, so there really is no cost to run it. So you would expect a lower fee structure there. The fees overall are consistent with the prior year, and they're consistent with the mid-range of peers. There has been a change in mix, which I'm going to talk about because this will start to play out next year. Barry mentioned the project that SIS did to, I would say, beat up on our public equity managers in particular. We're seeing the savings of that, upwards of, we think, $1.5 million a year for going through that process. Within the general pool, our largest fixed income manager, we were able to negotiate a fee concession for the year, which resulted in $700,000 in savings. The other thing is, in terms of, this is something where the general counsel's office is very helpful to us as well. There's a big movement with alternative investments for transparency and sort of standing up for investor rights. There's an organization nationally that we belong to. I just wanted you to know that we're strong advocates for negotiating legal terms with our investment managers for full transparency, disclosure of fees. So all the things that you read institutional investors wanting to be proactive about, we are doing that in all the legal negotiations that we have with investment managers. So we're very proactive. And then we have several new managers in the new structure that I just want to highlight and get back to Barry's comment that we would actually like our fees to go up in some cases. The first thing, getting back to public equities, if we were to look at it line item by line item, public equity fees that we pay actually dropped by 11% during the year. They went from 51 basis points to 45 basis points. And that's the bulk of the portfolio. That's a good 50% of the portfolio. So what happened in terms of the fees overall staying the same? It comes down to private equity and real estate. So private equity fees were up by 20 basis points and real estate was up by 30 basis points. It's actually a very simple reason, but it's a reason that no one likes to hear, and it's the nature of the beast. On most private equity and real estate vehicles, not all, but most, when you commit capital, the management fees start. So even before the manager has invested the cash or called the cash, the fees start. So in both of these cases, we're growing the we're growing the real estate portfolio, and we're growing the private equity portfolio. And what went on during the year is we had a significant increase in commitments to managers. So that means that the fees paid went through in the year because the commitments went up before the capital was drawn. So you have a larger number in the numerator, and the denominator is the same. So we think that's a blip as we're building the portfolio out. And combined with the other things we've done in the equity portfolio, we expect the fees to be down next year. And again, if we look at just equity fees alone, they were down 11.7%. Endowment pool, again, similar story, and they were relatively flat. In terms of managers, so again, just to sort of address what we're doing proactively, the Portable Alpha program, we brought in 3 new products and strategies. And just as an example, typical hedge fund fees, which you're accustomed to reading about, 2 and 20. 2% management fee, 20% incentive fee. So 2 of the products in the Portable Alpha program, we negotiated down to a 50 basis point management fee. So 50 as opposed to 200, and the incentive fee is 12.5% versus 20. Another product that we went into, which we helped the firm launch, we got favorable pricing, we're paying a 50 basis point management fee, and the incentive fee is 9%. So I'm making the point that we're aggressive in going after managers, and fees are important, and we're fighting for them when we can.
And let me say this, since I've been one of the naysayers, I want to compliment you and tell you how personally happy I am that you are beating some of these money runners down on fees.
And Barry loves to beat up on them too. So.
These are extraordinary results.
And I would also say that these 3 managers in particular were the 3 managers that delivered truly outstanding returns in the month of September. So we're very pleased to partner with them, and you'll have an opportunity to meet with one of them soon. The other thing I'd mention back to the equity portfolio, we've been creative in negotiating fees with managers. And so one example in the style premia section, think of it, call it smart beta. The fee that we negotiated on that is 9.5 basis points. And that's partly because of a relationship that we had. We were one of the first to fund this index, but it's an index passive product run by BlackRock. It's a global portfolio, 9.5 basis points of fees. That's 0.09. The interesting ones on the equity portfolio, so one of them is sort of what we believe to be a smart beta product that will deliver additional return. We've negotiated a 0% management fee and an incentive fee of 15% that slides down to 10. One of the other equity managers we brought in, we also negotiated a 0% management fee, and in their case, it's a 30% incentive fee. So what that means in terms of aligning our interests with the manager, if that manager delivers us a benchmark return, they get paid nothing. We could have owned the benchmark. We don't need to pay them to deliver value. If they lose money if they perform below the benchmark, they get paid nothing. If they perform below the benchmark and then they turn their performance around, they don't get paid anything until they've made up for what they've underperformed the benchmark. But when they outperform the benchmark, they get paid. So if they deliver 30 basis points of outperformance, in this case, they get roughly 10 basis points. That's not a big fee. That performance is not something you get excited about. But if they deliver 300 basis points of performance above the benchmark, they will get 100 basis points, but we will get 200 basis points. So it's sort of this alignment of interests that we're after with our managers so that when we win, they win. If they don't deliver, they don't get paid. So that's where Barry's comment came, that we would actually like to see our equity fees go up because that would be a signal that we'd had pretty significant outperformance. So those are the things we're working on. We're also big on strategic partnerships. One of our other hedge funds I just mentioned in closing on this topic, 2 years ago, we went from a commingled product into a custom mix where it's just us, we self-selected funds. We were able to cut our fees by 30% by doing that, by having enough of a relationship and capital with this manager for a 30% cut in fees. We've looked back on it, and again, this is from late 2012. Our custom mix has returned cumulatively 24%. The commingled account has returned 14%. So in that case, we were able to cut our fees and significantly outperform what we left behind. So anytime we have an opportunity to do this, of course, we're doing it. We want low fees. We want to be able to come here next year and show you that we've cut the fees, but we also want to deliver the performance. And I think we're very comfortable with where we are in the portfolio to be able to do that going forward.
John, before
Yeah.
you leave that, and I like that fee structure sounds good. What does that do to risk?
Well, so from a business perspective, if you're on the other end, it's that high water mark at zero, which means, again, if they don't deliver, they don't get paid, and they have to make up what they lose. So the risk constraints that well, let me go back to the main point. The risk constraints are the same regardless of the fee structure. So the manager that I mentioned to you at the 0 and 30, they run the same strategy, and you can get that same strategy with a fixed fee. They're indifferent to how you structure the fee because they're running the product the same regardless, and they have the same risk parameters regardless. But our protection ultimately is that they have to make up their losses. So that's a big check on the risk that they're taking.
So we can monitor how they're doing with clients that don't have the performance-based fee. And if it's different from ours, then we're concerned.
Yeah. But they're running it in a way that's very risk controlled. It's just the nature of the strategy. But that's a great question.
It is a great question. I would say one of the risks, and I would characterize it as a human nature risk. Tom mentioned if somebody falls behind, we don't pay them until they catch up. So we may have this human nature that if we have a big bank of unpaid fees, we won't fire a manager because we're going to get them for free for the next 3 years. And that's a risk we have to be very cognizant of. Don't hold on to a manager just because you have a nice bank of unpaid fees.
Thank you.
So Tom, is the industry moving in this direction of trying to negotiate those fees on a performance basis in general across, is that?
The proactive investors are, I mean, obviously not. When I mention this to some managers, they look at me with a blank stare, like, wow, I can't believe they're doing that. What that tells me is that there are managers out there that have confidence in their ability to deliver, and there are those that don't have the same level of
If that's true,
confidence.
why wouldn't we be trying to do this with every single person that's managing any of our funds?
We do, we would.
Okay.
But it's the nature of, if you're going to offer that to a client, you have to have an especially high conviction in your ability to deliver, and of course, that's also why we selected them. I think what I observe when you ask the question is that maybe other managers are not comfortable with that.
Well, if they're not comfortable, then they're probably not comfortable in their ability to perform.
That's,
So why wouldn't we be going with the people that are comfortable with that?
They also could be comfortable because there's enough demand for their product that they can say no to you. There's enough people standing in line that's willing to invest in me, so I don't need to do that kind of risk-taking or risk-sharing.
Not every lawyer negotiates their contingent fee. Some of the better ones don't. I think you're making progress, and you've shown that you are bearing down on the management fees, which several of us, are concerned about. So this past year has been a good shift, and I'll probably raise it every year just to keep the dialogue going. But
it's good.
I think you're making progress. Keep it alive.
I like what you're doing. I think you just need to keep doing it and do more of it if you can.
We will. Again, we feel pretty good about the structure going forward. We'll have, ups and downs, but I feel pretty good. With that, I have to end on a note that's less than ideal. This is something we present every year just to kind of give you a sense. As a reminder, September 30th, October 1st is the measurement date for actuarial purposes for the pension plan. As of June 30th, which is the left side of the chart, you can see, and we just went over, we had about a 1.1% return. So the September 2014 month dropped off. That was a 2.1% loss. But what we're picking up is still unknown. Through August, we were down roughly 1.9%, but we're down more in September. I can't tell you the exact amount. Obviously, it's the first, and we won't have numbers for another 2 weeks. I'm pretty confident that, even though we lost the 2.1%, I think the loss that's going to replace that is going to be larger. Maybe best case scenario for again, September 30th is that we're flat. And again, it's just the math and the nature of the markets and what's going on, and that's the risk of the pension plan.
And the fiscal year is October 1 to September 30th, right?
For actuarial purposes, yes,
Yeah.
yes, that's true. For the pension plan, that's the fiscal year. So again, just looking forward to close, the asset allocation changes have been implemented. The only thing that's left to do, commodity exposure, we're phasing that in over 3 months, so we're 1/3 done. Equity portfolio is largely restructured. We're going to take a hard look at currency hedging. If we decide that we should do anything with that, we may ask to come back to the board in December to talk about that. And then, again, for private equity and real estate, we continue to grow those portfolios to the targets that have been approved by the board.
Kind of forgotten, do our current guidelines or the authority that you're given, do they currently allow hedging in currency?
Not explicitly if we do it at a portfolio level. Managers themselves can do that. That's one of the things that we want to take a look at.
Any other questions for Tom or Barry? If not, thank both of you very much.
Thank you.
Appreciate it. Brian?
The investment consultant is an annual decision by the board to advise management. It's a hire by the board. And management is recommending, as you can see on Finance 1-1, our first action item, the retention of SIS and Mr. Dennis's firm for another year. The fee will be at the same that it's been this year. We think we get tremendous advice. And the things you heard Tom talk about, I should start with, there's no question, as I enter my second year here as your chief financial officer, that Tom takes to heart the concern of the board around fees and that type of thing. But we also, at the end of the day, it's about performance, and we need to do as best we can with the tools we have and within the governance you've given us. But I think if you've seen what he's done, I mean, that's really trailblazing in a lot of ways in the market to go and press managers to align interests the way he's done that. And so and that has happened with the support of Mr. Dennis and his firm. Barry advises a lot of different pension funds across the United States. It's in the material we gave to you. But those two working together, you're starting to see reacting and implementing the policies directed by this board. And so I think it's a good team. I think it should be retained for another year. And the President and my recommendation is to retain SIS for another year in this structure.
Are there questions with respect to this?
I've already let it slip that I thought the fees were relatively modest, so I guess I can't vote against it.
This requires board action, right?
Yes, it's an action item, open the 1-2. It's a recommendation from myself and the president to retain SIS for another year, but they are truly a hire of this board.
I
Are we
would move
getting out of?
approval.
I would ask for a motion from the Finance Committee to recommend to the board approval
Madam,
of
I'll-
retention of SIS.
So moved.
Moved and seconded.
Are we getting out-of-state tuition still?
We are still getting out-of-state tuition, but I think she's on track to graduate in May, right, Barry? So we're getting some of our feedback at the MU campus. That's correct,
Okay.
yes. So-
Thank you.
In all seriousness, I think those fee negotiations are fabulous, and I think the consultant and Tom both should be complimented on it.
Yeah.
I'm very impressed with that.
Yeah, that's not an easy thing to leverage. I mean, we think we're a big player, but when you go play with pension systems that are 20 or 30 or 40 times our size, I mean,
I
to
think
go get
Don
that
and I
done.
have both been in positions where we tried that and weren't successful at all, so I'm very impressed.
Thank you.
Are there any other questions? There's a motion and a second in the committee. Anything further before the committee vote? Cindy?
Curator Covington?
Yes.
Curator Phillips?
Yes.
Curator Snowden?
Yes?
Curator Steelman?
Yes.
Okay. All votes in favor of the committee?
Thank you, Mr. Chairman. The committee recommends that the investment consulting firm's Strategic Investment Solutions be retained for 1 year, and that's a motion.
Second.
Okay, discussion? Cindy?
Curator Covington?
Yes.
Curator Cups?
Yes.
Curator Graham?
Yes.
Curator Henriksen?
Yes.
Curator Phillips?
Yes.
Curator Snowden?
Yes?
Curator Steelman?
Yes.
And Curator Stewart?
Aye.
Okay, all votes in favor.
Thank you. Brian?
Thank you. Members of the board, the next action item for you actually relates to Vice President Foley's presentation earlier in the day. And essentially, to help facilitate this investment in the MU Accelerator Fund, we need to make a change to the general pool, because right now, the general pool does not allow investments into venture funds. So the way we looked at it when Vice President Foley approached us about how to facilitate this, we felt it was best to carve an asset class out of the general pool that would have a limit of $5 million. And the red line version of that's in your materials, but essentially it'd be like 0.3% of the general pool would be invested this way. We certainly are happy to make sure inform the board of how that's going. But the funds are there. It has my support. It has the president's support. And candidly, this is just the way to go work through the process and help get that investment made. And I'd recommend its approval.
I'm going to be in favor of, I do have a question. Didn't you say that it was coming out of the MU funds, not but the general pool is university-wide?
So the funds are going back to MU. That's where the licensing revenue came, but you're correct. It is coming into the general pool belongs to the entire system. So yes, that's correct. This particular investment is coming from MU, the one that we're about to do for this fund. We could do others that would total $5 million, and the sources could be different. Maybe, maybe not. But what we wanted to do was set up a structure where we wouldn't have to come back and amend the CRR, but we can certainly report to you, and we'll be working closely with Hank and the folks and Bill Turpin and those types of folks to how we put this investment together. So yes, it's an MU investment inside the UM general pool.
So another way to put that is that both Brian and Steve Owens working together had to devise a mechanism that was within our rules that would allow us to do this in a way that was uniform with how we've done other things, right, Brian? And this was one way to do that.
We're actually setting up the documentation to be very similar how we invest other parts of our portfolio in venture funds, with the same documentation, the same due diligence. Bring in Tonson Coburn from St. Louis to do the same due diligence. In this case, the approval of these investments would be just a little bit different than our other ones. As Tom talked to you earlier, Barry, Tom, and myself, along with concurrence of the president and legal counsel, we can hire or fire any manager or make any investment. We would replace Barry in this process with Vice President Foley's position, just because it would be Tom's position, my position, and the Vice President for Academic Affairs for this piece, because it isn't something that SIS is going to opine on an investment like this. So we were keeping the structure the same. It would still require concurrence of the president and general counsel, but we've made that one switch. But we think it's very efficient the way that the board has delegated those decisions to management.
Any other questions? If not, I would entertain a motion from within the committee to recommend to the board that we amend the collected rules and regulations 140.012 as already outlined before the board. Is there such a motion within the committee?
Second.
Cindy?
Curator Covington?
Yes.
Curator Phillips?
Yes.
Curator Snowden?
Yes?
Curator Steelman?
Yes.
Okay, all committee votes in favor?
Thank you, Mr. Chairman. The committee moves to the board the amendment to 140.012.
Thank you. Is there a second?
Second.
My understanding of the rule change would allow S&T or UMKC or UMSL to do the same same structure if they so desire.
There's room inside the authority you would be granting us under this rule to have other investments come through that, but it would have to meet our, we'd have to look at it carefully and make sure it met the tenets of this, and we would give it the same scrutiny we're giving this investment. Yes, sir. So this is not just for one of the campuses, it'd be for all 4.
Were you asking whether the other campuses could set up a similar accelerator? Yeah.
Yeah, they could. Up to 5 million before we'd have to come back and talk to the board. But it would still be the same approval process of Vice President Foley, myself, and Tom, along with concurrence from the President and the General Counsel.
Other questions? Cindy?
Curator Covington?
Yes.
Curator Cups?
Yes.
Curator Graham?
Yes.
Curator Henriksen?
Yes.
Curator Phillips?
Yes.
Curator Snowden?
Yes.
Curator Steelman?
Yes.
Curator Stewart?
Aye.
All votes in favor.
Next item, project approval.
We have 2 project approval items, and that will be the last 2 things on the finance agenda for today. The first one is at Missouri S&T in Rolla, and and you've heard about this project many times as we worked hard on getting the legislative support, but this would be half of Schrank Hall's renovation, which is desperately needed. It was built in 1938. I believe the governor's been there at least a couple of times since this project has been approved. It's been very high in the mind of many down there. And you can see at the top of the information page that about 12 million is coming from the state bond, $1 million from the campus, and 5.1 million from system to help make this, to get half this building done. And that was the same at Spencer Chemistry here at UMKC and Benton Stadler at UMSL. We're getting half a project done, and the only way it could get done, because the state dollars wouldn't take care of all of the half a building, was if the campuses and system didn't have to lay some money on top. So we're pleased with moving this forward. We'd sure like to figure out how to get the rest of it done at some point in the near future, and we'd recommend its approval.
Any questions? If not, I would entertain a motion from within the committee, please, to recommend to the board project approval for Schrank Hall renovation Phase 2 as set forth in the materials.
Move approval.
Second.
Questions? No? Cindy?
Curator Covington?
Yes.
Curator Phillips?
Yes.
Curator Snowden?
Yes.
Curator Steelman?
Aye.
Okay. All committee votes in favor.
Mr. Chairman, the committee moves for project approval for Schrank Hall renovation Phase 2 as set forth in the materials.
Second?
Second.
Cindy?
Curator Covington?
Yes.
Curator Cups?
Yes.
Curator Graham?
Yes.
Curator Henriksen?
Yes.
Curator Phillips?
Yes.
Curator Snowden?
Yes.
Curator Steelman?
Yes.
Curator Stewart?
Aye.
All votes in favor.
Stewart Hall.
And the final project is Stewart Hall on the MU campus. Again, this is also a piece of the state bonding authority, the $95 million given to the UM system last year. On top of that, this wouldn't have finished Stewart Hall. This would be a complete renovation of a building built in 1912. It's very important to the biological sciences labs on the campus. The campus was put in about $500,000, and the system brought $5 million to help get this project done as well. And let me just remind the members of the board, the central bank source of money for this project in Schrank was refinancing debt that took place under Tom Richards and his staff. And so we're putting that money back to work on the campuses when we refinance that debt. So again, Stewart Hall would not have been able to be done with just the state money. $5.5 million of both campus and system money will ensure Stewart Hall is completely done, and we recommend its approval.
Questions for Brian? If not, please, a motion from the committee with respect to approving the renovation for Stewart Hall.
So moved.
Second.
Cindy?
Curator Covington?
Yes.
Curator Phillips?
Yes.
Curator Snowden?
Yes.
Curator Steelman?
Yes.
Okay. All committee votes in favor.
Mr. Chairman, the committee recommends to the full board to approve the project for Stewart Hall renovation, University of Missouri Columbia.
Is there a second?
Second.
Any discussion? Cindy?
Curator Covington?
Yes.
Curator Cups?
Yes.
Curator Graham?
Yes.
Curator Henriksen?
Yes.
Curator Phillips?
Yes.
Curator Snowden?
Yes.
Curator Steelman?
Yes.
Curator Stewart?
Aye.
Okay. All votes in favor.
Thank you very much, Brian. Is there a motion from within the committee to adjourn the Finance Committee meeting?
So moved.
Second.
Curator Covington?
Yes?
Curator Phillips?
Yes.
Curator Snowden?
Yes.
Curator Steelman?
Yes.
Okay. All votes in favor.
I believe that concludes the public session for today. The board will now go into executive session, and we will reconvene the public session at 9 a.m. tomorrow. Thank you.